Cheryl with BI Real Estate and Staging, and today I am bringing a good friend on, someone that I've gotten to know pretty well. Actually, we met, I want to say, what, about 3 months ago, but we have been talking consistently and just talking about both of our businesses and the industry and everything, and just trying to be a support to one another. So I just wanted to have him on today to discuss what he does, the areas that he concentrates and get into a little bit about the different products that he has as well. So today I have Arvin Talley with Elixir Mortgage, correct? And yeah, Arvin, tell us how you got into the mortgage industry.
Well, thank you for having me.
You're welcome.
I started out after getting out of college, trying to do a soul search of where I want to be and how I want to make a difference. And my mom at the time, she was a realtor, and she was pushing me to be a realtor. Okay. And I did a realtor job for about maybe 3.5 years or so. And it was just very, very difficult job for me. So I thought, well, maybe I'll get on the finance side, and I really enjoy numbers. And it was a home run for me. So I started 7 years ago in the side of the real estate. And about 2 years ago, I started my own company and got into the residential and commercial part of multi-unit.
Oh, wow. Okay, awesome. So before you started your company, you worked somewhere else. What would you say the difference is, and what challenges have you come up against having your own company versus working for someone else?
The challenges are pretty much nearly the same. The only major obstacle is most of the places I worked were volume shops, and volume shops, it's a lot of churn and burn, not just with the process of lending, but also with employees. And they were not the easiest environments to work in, but also it hones your skill set when you go on your own too. So I'm very thankful for that. And every day that has, its pressures and everything else that comes with being self-employed, but it's been very, very gratifying and fulfilling.
Awesome. I feel the same way because I actually hung my license with, I would say, about 3 real estate companies before I actually went out on my own about 3 years ago. And it is a lot of work, being pretty much a one-woman show and, having a couple assistants here and there. But it really is, it's gratifying. It's freedom. It's freedom. It feels awesome.
It is definitely fulfilling, for sure.
Yeah.
They don't teach you a lot of things, and I learned what I could learn about lending, and I didn't know enough about marketing, or I thought I knew about financing as far as when it comes to spending for business. I had to learn everything on the fly, on the job.
Yeah, absolutely. Okay, and what are your areas of focus when it comes to loans and different loan products?
Asset-based financing, I apologize, I didn't jump in. Asset-based financing that's non-owner occupied, no income verification type financing for fixed and flips or long-term rentals or short-term rentals, which are Airbnb, vacation rentals, but financing them 5, 7, 10 years, 15 years, 30 years.
Oh, wow, that's awesome. So what are the requirements for that type of loan product?
So they vary depending on states. For example, you're in North Carolina with any FICO score, we can do an investment property. The catch the difference between an investment property versus somebody that lives in the home is the down payments. The requirements are more. So in North Carolina, for example, or Georgia, it's a minimum of 15 to 20% down. In North Carolina is 20%, but in Georgia it's 15. In Georgia, with 15% down, you can get in with a 640 FICO or greater. In North Carolina, there's no FICO score of any kind, but it's 20% down minimum.
And that's like a set amount just because of the state, because of North Carolina, or
it's investors. It's really the investors and their appetite. So the more populated states, they have usually lenient programs. So like California, Florida, there's more lenience on programs. And then the states that have a little bit less population, it seems like the constraints are a little bit different. North Carolina is still very flexible, in Georgia. But like if you go into, for example, the Dakotas, there's very few lenders doing it.
Okay, well, that's interesting. Okay. What are some important things for borrowers to know? I'm trying to look at my notes here that I took. I wanted to make sure I asked all the questions that were important or I thought was important for people to know. But what are some important things for borrowers to know when they're submitting a loan application?
Loan amounts matter. So anything under $75,000 loan amount is going to be much more difficult to get a loan, and in percentage, it's going to cost a lot more to do if you can find something. Okay. So it's 75 or 100,000 and above, it gets easier. In North Carolina, if you go over 150,000, the options are quite a bit. But the minute you land under that 100,000, you're like in a little hole with a few options of investors, and it's less competitive. So it's a matter of where investors want to be on financing these properties. Is if you land in those constraints, you're better terms. That's just ultimately the case.
Okay. I know before, I guess the going number was 50,000. So anything below 50,000, you can't really get a loan. Is that still the same amount, or can you go lower? How does that work?
There's investors that will do 40,000 or less that I know of. The challenge is if you're going to spend 3, 4, 5 weeks on a loan and you have to charge for that, there's a bare minimum amount that you have to charge, and it is not going to line up with those numbers. So because that, there's a thing as a high cost loan, and then there's something in this scenario that's just not going to line up. So once it goes over 75,000, these numbers and percentage start looking better. And that's really the reason behind it. But I know investors that could do 40 and up. The numbers don't happen. I mean, if you're going to spend $5,000 to do a $40,000 loan, it's going to sound insane.
Right. Wow.
It just won't line up.
Yeah, that makes sense. That makes sense. Do you have any loan products that maybe a lot of other companies don't have? Something that sticks out that you could think of that would be beneficial to borrowers?
Absolutely. So first off, foreign national, there's a lot of foreign money that's coming into this country that these are folks with no social security numbers, and they are residents of other countries, which can be foreign nationals, and they can use them as Airbnbs, they can rent them out. They cannot live in them, but they can do financing for them, which is unusual. And folks who have over a 740 FICO score looking to do long-term rental, which was 15% down payment, which that is a big deal for long-term.
When you say long-term, is it 30 year? Do you ever go past 30 years? Do you have loans that are longer than 30 years, or is it just a standard 30 year?
They're generally amortized over 25 or 30 years, and they could be a 5-year ARM, a 7-year ARM, a 10-year ARM, a 15-year fixed, or a 30-year. Those are the options.
Okay.
Interest only or fully amortized.
Okay. And so that 15% down loan. You said it's for investors, and that's
for
for
investors.
like long-term rental.
Exactly. So they
So you
have
purchase a rental property, right? And it could it be a single family, or does it have to be multi units? Does it matter? Single, it
four
can be single.
multi-units. It could be
Okay,
up
as
to
long as
40
it's just a
units.
rental property.
Exactly.
Okay.
Key is they have to have tenants in place to do a long-term rental. You cannot buy a property and try to rehab it with no tenants in there and buy a long-term rental. You have to do a fix and flip loan first, fix it, do the renovation, get tenants with contracts in, and then do a long-term rental. It has to be in stages. You have to have rentals. There's rental contracts and tenants in place.
Gotcha. Now, what if I have a scenario where I have a client and they happen to be, they're an investor, but they want to purchase a property that has 2 or more units. That way they're living in one unit and then they're renting out the other unit or other units. Do you have loan products for that? Or are there loan products? What is that?
There is, but that's still considered owner occupied. Even if you rent one unit out, that's still considered owner occupied. That'd be outside of what I would be able to do. Occupied would be maybe still a conventional loan, FHA loan, PA loan, maybe some kind of bank statement loan. But it won't. If you live in it, it's still considered owner occupied.
Wow. Okay. And I know what is it? I think up to 4 units is considered. Still considered residential, but then after that it's commercial.
Exactly.
So okay. Do you do any type of commercial lending?
Absolutely. So from 5 units to 40 units.
Okay.
Unit properties.
But even in that type of scenario, if an owner lives in there, it won't work.
Yeah.
It won't work. Gotcha. Okay. All right. Cool. All right. And I think the other question I had was loan requirements. What are the loan requirements for that type of loan?
For 5 to 40 units?
For the loan that you were saying that's 15% down, because I know for a fact a lot of my investor clients with those type of loans, they're typically 20. So I want to make sure that I know what the requirements are, because I'm definitely going to tell some of my clients that, hey, I know a lender that, you guys should put 15% down. And so what would the requirements be for that as far as the credit scores, any type of documentation they would have to present to close out that type of loan?
So 15% down works very well with FICO 740 or higher, because at that point you have good credit and you'll get good rates.
Okay.
So typically rates starting from probably maybe 4.625 and higher. Most of them range in the 5s, but for investment property, that is quite remarkable. 15% down works to a loan's about $750,000. After $750,000, the requirements start changing and becoming a little bit more down payment. But you can do a loan from 600 and up FICO, it will just require more down payment.
More down payment and possibly, and definitely probably a higher interest rate.
Exactly.
Okay, and how what's the max loan amount that you can lend to someone?
On multi-units?
Yes.
Up to $50 million.
Not bad. Pretty good. Okay. Do you have any information that you want to share that may be something I didn't ask that you think would be good for borrowers to know, that would be beneficial to them?
Absolutely. So especially for folks who are just starting out fix and flip, experienced folks, they're experienced, they're already up and running. But for somebody that wants to get into this arena, the things you really want to make sure you do beforehand. Make sure that you speak to someone that is good with credit. If your credit has any blemishes, clean it up. Because cost of money is higher when your credit is not as good. Doesn't mean you can't do it, But if you have time and you can plan for this 3 or 6 months in advance, start looking to repair your car. That's a good starting point.
And what is that that number that they should be at when you say good credit? Like, what is that credit score that they should try to attain to be at?
On fix and flip, you can go with any FICO score, but if you're looking at a long-term rental, you're generally going to need a 600, 620. But for numbers to start working out well, you got to be between 680 and 700.
Okay. All right. That sounds
That's
good.
really the key.
Okay. All right.
And yeah, in the case you were asking me about this, calculation of numbers is critical for someone that's just starting out, and even some seasoned people that overlook these things. With most investors, when you do a multi-unit property, for example, you've got to have your down payment,
Mm-hmm.
closing costs. A lot of people overlook solid closing costs. Generally, they're going to make you pay 1 year of your insurance premium in advance. So you have to make sure you have that plus reserves because they're going to impound that.
Okay.
And lastly, there is reserve requirements in most cases, anywhere between 4 months to 9 months of the housing payment you have to have on hand, or it could be 401k, IRA, but 401k or IRA, they generally calculate 60 to 70% of the value of what you have, not 100%.
Okay.
And tend to overlook that area on closing costs time and time again, even some more seasoned folks do.
Okay, so what would you say the standard closing costs, the cost is? I know for regular, just residential, I usually say about 3% of the sales price. What would you say the closing costs are typically on an investment loan? Like how much?
So investment properties, they vary on experience. It varies on where I can take it because their credit is good. It could be anywhere from 1.5 points to 3.5 points, depending on loan size and availability of credit for that specific situation. Most cases, they're going to be between 2.5 to 3%. But if the price point gets higher, a lender a lot of times may be willing to percentage-wise lower their percentage because they can still earn enough money doing that. And so all of that matters.
Okay. So when it comes to, I know there's something called predatory lending, correct? And there's a certain amount that a lender can charge for points and fees and things like that. What is that amount? Like what should people look out for if they see something? Because I've seen up to 4 points on a loan, but I don't know, is that okay? Or is that just too high? Like where's the threshold where it's just like, okay, we're teetering in the predatory lending area?
Predatory lending does exist, and the situation this day and age in 2020, lending has not eased up enough where people can go and buy like they used to. So right now, the biggest challenge is everybody wants more down payment. So these are asset-based loans. And depending on the individual situation, it can be, I've heard of 5%, 6%, or 5 or 6 points charges. But somebody that's paying 5 or 6 points charges, they're going to a lender of last resort, meaning that they have nowhere else to go. Okay, if you did, in that scenario, your best bet, if you own the property, is just to sell it. Okay. To finance it. But if you choose to finance it and nobody else can give you a loan, what other choice do you really have? And there are loans out there, especially there's so-called business loans where they cross-collateralize with the property. They're not even in percentage of points, they're in factor, where I've heard of as much as 1.5 factor 6 month term. What does that really mean? That means you got to pay 1.5 times that loan back in a 6 month period. And if you do that, in an annual basis, all of a sudden you're talking about, 100% back.
Wow.
Yeah, quite a bit.
Wow.
So those loans exist, and yes, they are predatory loans. The obstacle, most cases, is make sure what you sign up for, you can pay it back, and you're not over optimistic. If somebody says, I'm selling my home for $200,000, and in your heart and everything that you've done and researched, the facts, data says you can sell it for $400,000,
Yeah.
you have room to do this. But if you're just being optimistic to pay that loan back,
Mm-hmm.
it's one or two things can go wrong and you're finished.
Yeah.
It's a loan for you.
So pretty much you definitely need to have some type of exit strategy, right?
You always have to have an exit
Yeah.
in your investment property. If you don't have that,
And more than one, like try to come up with at least 3, right?
it's possible. I mean, it has to be a slam dunk. There's no 100% guarantees in business, unfortunately.
That's right.
But it has to be a slam dunk. You literally have to have data that supports that. If you're
Right.
just that you're going to, build this beautiful property that's just nobody has anything like it, there's no comp like it, and somebody will come and pay you that, it's just too optimistic on our end.
Right, right. As a matter of fact, just what you just said, like you should not be aiming to, if the neighborhood does not call for marble floors and all this other type of extravagant things that you're trying to put in the house, don't do it. Because now you're making it not a slam dunk. You could put yourself in, a lot of financial trouble because you're not going to be able to recoup all that luxury that you're putting in there when it's not necessary. So.
Exactly. Or you're looking for a buyer that in percentage is so difficult to find.
Right.
If you're looking to be a game changer in a space, this is not the kind of lending or any type of high price or high cost lending to be a game changer.
That's a good point. That's a good point. That's good. Oh, wow. Okay. Well, I've enjoyed our talk. I've gotten some good information, and hopefully our viewers have received some great information as well. Guys, if you have any questions or any comments, please leave them in comments and let us know. We're trying to just get out here and have this platform to help consumers and help you be more educated and make better choices and the decisions when you're in this industry trying to get a loan, purchase a house, purchase investment property. So I'm pretty sure I'll have you on again, Arvin, with a different topic, because real estate is so vast and so broad. There's so many things to cover, and I look forward to having you on again.
Thank you for having me, Des.
All right, until next time, I will see you later. Everyone be inspired, have an inspired day, and act on your inspiration.